Before we take a look at a bit of a favourite here on the call, comes up pretty regularly. Nick Scali, the retailer, the furniture retailer. Reporting season well underway. We're a bit spoilt for choice with our stocks today, but Nick Scali more than doubling full year profits. The retailer is also set to dish out a 40% increase or 40 cents per share dividend. Nick Scali failing to provide full year guidance due to what it calls a high degree of uncertainty in the current retail environment, but the last 12 months was, and they've done all right. However, the company did acknowledge buoyant trading conditions at the moment. Carl, what do you think of the result and also Nick Scali as a stock? It's an interesting business, isn't it? It's basically founder run, the family still run the business. If you've ever bought Nick Scali furniture, you buy it and they say, we'll deliver it in 3 months. So it's a great business model because they don't actually make it until you pay for it. So it's been a winner.
It's very clever. Yeah, very, very clever business model. And I chuckled when you said 3 months because the wait's about that long at the moment, because I was in a Nick Scali showroom not that long ago, and that's what we were told to do. And I think this result is juiced largely by this idea of when you walk in at the moment, you pretty much take what you can get. So it's not a matter of haggling on price. It's a matter of take it or leave it, because if you don't buy it, the next person that walks in the door probably is going to buy it. So, yes, retailers, not just Nick Scali, they're very lucky at the moment. Their margins are way up, and they're obviously sales are riding the COVID. I mean, this FY is all about COVID and its impact and lockdowns and people therefore refurnishing their homes, and Nick Scali taking advantage of that. So they're probably the two key themes. A big bump in earnings. Potentially, you could argue it's abnormal. It won't last, and then also the other feature is those great margins. Look, just on the result, it was a beat on our numbers, so a little bit higher than expected, order of magnitude 5%. The dividend was disappointing. The company has chosen to pay a smaller dividend than anticipated, obviously because you mentioned the uncertainty due to current lockdowns. They're also thinking of doing an acquisition of Plush. That's in the market. They've been talking to Plush. So I think they just want to keep some cash around, keep the balance sheet strong. So that's a little bit disappointing, but I would remind investors that the money is still there. It hasn't gone anywhere. It's if they wanted to increase their dividend next time around, they could. So look, I think it's a great result. I think looking forward, that's the key with any business, and you have to then say, well, like for like comparisons going forward aren't going to be as fantastic. We're not going to see these doubling of profits down the track, and then you've got to figure out what growth rate you apply to it when you do your discounted cash flow valuation. So I think earnings are going to be pretty flat. I think tailwinds are coming from just the stage of the cycle we're in. So I think we're in the right stage of the cycle for retailers, just with local economic growth and where we are. But then just flat comparisons. I don't think the business is expensive. I've got fair value. My price target's sort of in the 13s. So I still think there's a bit of upside there. The chart looks really good. Bottom left, top right, lots of consolidation recently. A little bit of a breakout to the upside before this announcement. A little bit of disappointing the market today, I think, with maybe that dividend and not providing guidance, but I think it will recover, and the value and the quality is there. So, incredible return on equity, probably one of the best in the market, over 50% per annum. And I'm kind of gushing because, I do love this stock. Every time I've been on the call, I've called it a buy, and I'm happy to reiterate the buy that we have in the system on this one.
Do you think this is we've had a couple of stocks having this early part of the earnings season just not giving any guidance at all? Do you think that's going to be a feature of this earnings season, that executives are going to wimp out?
I don't think they're wimping out. I think there's some pretty significant reasons why they might just want to pull back on it, and it'll be sector specific. So you can understand why Nick Scali might do it, and then you might understand why, say, a BHP or a Rio won't do it, because just local lockdowns versus international factors.
Okay. All right, Ben, what do you think of the Nick Scali result and the stock at these levels?
Yeah, I'd pretty much echo all of Carl's comments there. I thought it was an awesome result. The guidance you're asking there, Koshi, I think the more relevant things that we are going to see in this earnings season is a lot of attention paid to guidance. I think you're going to see a lot of beats coming through in this earnings season. And on the back of that, I think that's kind of largely been priced in with this roaring share market that we've seen over the first half of this year. I think the attention is really going to turn to the earnings outlook. Nick Scali sort of said that sales for July were down 27% versus July 2020. And of course, that's because a lot of the stores at the moment are not allowed to open. But then you wonder if that's going to create this pent-up demand that we saw in the first nationwide lockdowns, where everyone rushed into these shops, realised that they needed items of furniture. I probably underestimated, I sort of thought that last year was a bit of a one-off sugar hit, because I just thought, people weren't set up for working from home. They were spending more time around the house. So they went and, sort of furnished the house a bit more, spent some more money in that side of it. And that maybe that was kind of like one-off purchases and they wouldn't come back this year, but that it clearly has continued. And, as Carl was saying, you've got great operators here. Couple of other points, they're still planning on rolling out about another 25 stores. That's their goal. They haven't got a set time frame on that. It's almost a 1/3 increase on their stores. So you can get really good growth in retail from store rollout, which they seem to be continuing to plan on. I think it's a buy as well. I don't think it looks overly expensive. I think that it's a very strong result. The share price has come off today with, I think, more attention paid to that guidance. But I think you're probably going to see it continue to run.